Insurance valuation. Insurance valuation. The main contingency against which the property owner must cover himself by insurance is damage to, or destruction of a fabric of his buildings by some accidental causes such as fire, riot, explosions, earthquake, busting water pipes, overflowing tanks, etc. However, we shall be concerned with valuation of properties for fire insurance purposes. The principles are the same whatever the risk. Concept. Insurance is a contract by which an insurer indemnifies the insured totally or partially for total or partial damages or losses that may occur due to perils or events specified in the contracts, which are called insurance policies. Insurance valuation is a prerequisite for insurance policy, and it is carried out to determine the insurable value upon which a premium for adequate cover is based. The aim of insurance is to transfer the risk of ownership to specialist agencies who are best suited to cope with them, whereas the insurers relying on the unlikely event of fire explosion receives annual premium. Contracts of insurance are governed by the doctrine of uberrima fide, that is, utmost good faith. All parties to an insurance contract are legally bound to disclose all material information necessary to execute the contract. Most other commercial contracts are governed by the doctrine of caveat emptor. Principles of insurance. The principle governing all insurance valuations is that of indemnity. THST is, compensation would be paid on proof of loss but only to the extent of loss casually suffered. Generally, an insurance policy expressly provides that the insurers will undertake, in the event of loss or damage by fire, to pay or make good the loss or damage up to a specified amount. The principles of contract of insurance are the following. 1. Indemnity. 2. Average clause. 3. The sum insured. I. Indemnity. The basis of insurance valuation are indemnity and b. Reinstatement. Indemnity reinstatement. 1. Financial compensation sufficient to place the insured in substantially the same position immediately before the loss occurred, old for old. In case of partial destruction, the cost of repairs at the time of loss less allowance for pre-fire depreciation, or for betterment where the repair result in better building than existed before the damage. 1. Reinstatement new is a modified principle of indemnity. Financial compensation sufficient to acquire a new asset to replace the lost one, new for old. 2. Valuation is made on the basis of replacing the existing property with substantially similar one in a comparable condition as at the time of loss. 2. Valuation is made in the basis of the cost of reinstating or replacing the existing asset with identical or substantially similar structure at today's cost. 3. Accrued depreciation is taken into account. 3. No allowance is made for depreciation. 4. Statement of claim would normally be either by insurers making use of repairs or cash equivalent as at the date or time of loss. 4. Settlement of claims would normally be by full repairs or total reinstatement replacement as at the date of reinstatement. 5. In the case of total destruction, it is by payment of a sum equal to the depreciation replacement cost or asterisk loss of the saleable value after the incident, whichever is less. 6. Usually, no allowance may be made for inflation. Settlement reflects the cost of replacing at the time of loss. 6. Statement reflects the cost of replacing or reinstating, not at the time of loss, but the time of eventual reinstatement or rebuilding. Allowance is therefore usually made for inflation. Settlement for reinstatement is made at the time of reinstatement. 7. If the property is not to be repaired, but to be sold, the measure of indemnity is the difference between the pre-fire and post-fire market value, provided that this difference is not more than cost of repairs less pre-fire depreciation. If repair is contemplated, it is the cost of repairs less pre-fire depreciation. Asterisk loss of the saleable value is equal to difference between pre-fire and post-fire MV. Reinstatement and inflation. When buildings or machinery are insured on reinstatement basis, provision can be made for inflation by selecting a figure. Provision is made for inflation, particularly when a policy is taken on the reinstatement basis, since variations are to occur in the time of loss and date of reinstatement of property, and the date of insurance and date of loss. The methods of making provision for inflation are: A. Valuation linked scheme, VLS. B. Adjustment premium policy, AP. C. National Reinsurance Value Scheme, NRV. The valuation-linked scheme. Provision is made for anticipated inflation in replacement values both during the policy term and also during the estimated maximum reinsurance period. The sum insured, although shown as a single figure, consists of the base value and allowance for inflation. Base value plus allowance for inflation is equal to full insurable value. The base value is the estimated insurable value of the property at the time of effecting the insurance. The inflation provision is the sum representing the increase in replacement costs resulting for anticipated inflation from the date of effecting the policy to the date of settlement. It is also a figure representing compounded effects of inflation anticipated during the insurance period up to the time of reinstatement or rebuilding. Example: if an insurance anticipates an inflation rate of 20% during the policy year and inflation rates of 30% and 15% respectively during an anticipated 2 years period to reinstate his property, his total sum insured assuming a base value of N100,000 is calculated as follows. Base value N100,000. Inflation provision for policy year: 20% of N100,000 20,000. Inflation provision for the next year: 30% of N100,000 plus N20,000 36,000. Inflation provision for the next year: 15% of N100,000 plus N20,000 plus 36,000, 23,400. Total inflation provision 79,400. Full insurable value N179,400. Fire insurance perils. I. Insurable perils fire, other than that caused by certain perils as detailed later. Lightning. Explosion of boilers used for domestic purpose only, or in a building not being part of a gas works, of gas used for domestic purposes or used for lighting or heating the building. Property damaged by water or other extinguishing agents used for extinguishing purposes. Property blown up to prevent a fire spreading. Damage occasioned by falling walls or parts of a building in which a fire takes place. Loss or damage of property removed from a burning building caused by rain, theft or damage during removal. 2. Accepted perils. Earthquake and volcanic eruption. Riot and civil commotion. War and related perils. 3. Special perils. Special perils describe those risks normally excluded from the original or standard fire policy, but which insurers are prepared to cover on certain conditions and at an additional premium. The special perils include explosion and spontaneous fermentation, heating or combustion, riot, civil commotion, strikes, lockout workers, malicious damage, etc. Storms, tempest, flood, earthquake, volcanoes subsidence, etc. Aircraft and other aerial devices dropping, overflowing of water tanks or pipe, etc. 4. Consequential losses. It must be remembered that a fire insurance policy does not extend to items of temporary alternative accommodation unless these are specifically mentioned. In many cases, their inclusion in the policy will be important, e.g. in some leases, a rent statement clause is inserted which provides that a lessee will not be liable for payment of rent whilst the building is out of use due to fire damage. Example: a single-family factory built 5 years ago provides 1000 m2 of net floor space including offices and stores. It is let at N20,000 per annum Friday lease. The lease document provides for insurance in the name of the freeholder. It was insured at the time of the building for N200,000. You are asked to advise whether the present cover is adequate. Valuation. Total floor space 1000 m2 net, 1200 m2. Cost at N180 m2, N216000. Architects, surveyors, etc. At 10%. 21,600. Rent for say 9 mths. 15,000. N252,660. But property is insured for N200,000. The present cover is inadequate. It should be increased to N253,000. 2. Average clause. Over-insurance is not necessarily to be the advantage of the insured. If, for example, the building which is insured for N30,000 is totally destroyed by fire, and it is possible for reinstatement to be completed to the sum of N25,000. In this case, the N30,000 is equal to shall represent the ceiling figure. On the other hand, under-insuring can work hardship on the insured. This is particularly so when the insurance company inserts the average clause, or conditions of average, in its policy. The average clause is aimed at encouraging insurance to the full value of the property at risk and serves as a shield for the insurer in limiting the extent of liability on pro rata basis. Such a clause might read thus: if the property shall at the time of the fire be of greater value than the sum insured, then the insured shall be considered as being his own insurer for the difference and shall bear a reasonable share of the loss accordingly. The formula for the average clause is sum insured x loss sustained, value of asset at the time of loss. The effect of such a clause would be as follows: suppose the value of the buildings at the time of fire is N40,000 and the sum for which it is insured is N30,000. The insurer's liability shall be limited to 3/4 of the loss, i.e. 3/4 of N30,000 is equal to N22,500. If the buildings are partially destroyed and the loss is agreed at N800, the sum payable is 3/4 x N800 is equal to N600. 3. Sum insured. The sum insured is the best evidence of the maximum limit of an insurer's liability under an insurance contract there as was originally requested by the insured party or as adjusted to reflect changes in replacement or reinstatement costs. In the USA, the sum insured is known as insurable value, i.e. OMV of the property less the indestructible part, land. For valuation methodology: I. Indemnity value. I. If the option is to repair or reinstate into the same position immediately before the loss occurred. Gross floor area X multiply by unit cost of comparison X, replacement costs at NM2, BCX, less depreciation X, DRC X, add professional fees X, debris removal X, consequential loss X, if applicable, X, indemnity value X. 2. If there is no intention to rebuild, indemnity value is calculated on the basis of diminution in market value. Capital value of the property, pre-fire, X, less market value of the site X, add cost of demolition, debris removal etc. X, indemnity value X. 3. An alternative to above is to determine the depreciated cost of replacement or reinstatement as is before the loss and the loss of saleable value, whichever is less. 4. Where the property is old and totally destroyed and reinstatement or replacement may not be a reasonable proposition, payment may be limited to the difference between the market value before and after the fire, i.e. loss of saleable value. B. Reinstatement value. Reinstatement value new disregards depreciation. Gross floor area X multiply by reinstatement cost at NM2X, reinstatement cost X, add professional fees X, debris removal cost XX, base value X, add allowance for inflation I, insurance year at X% X, policy year 2, reinstatement or building. Period say, 1 year at X% X. Consequential loss, if applicable, X. Reinstatement value XXXX. Example. The indemnity basis. GFA of the building 756 M2. Cost of construction M2 at 6,500. 4914,000. Less depreciation at say 25% 1228,500. DRC 3685,500. Add. Professional fees at 20% 737,100. Demolition and debris removal 1 lakh. Contingencies, say 50,000 887,100. Insurable value on indemnity basis 4572,600. B. The reinstatement value new basis. GFA of the building 756 M2. Cost of construction M2 at N6500. 4914,000. Add. Professional fees at 20% 982,000. Cost of demolition and debris removal 1 lakh. Contingencies, say 50,000. 1132,800. Base value 6046,820. Allowance for inflation. I. For insurance policy year at say 15% 900,720. 6953,820. 2. For 1 year reinstatement period at say 14% 973,535. Insurable value on reinstatement new basis 7927,300. Rating of premium. The rate of premium is taken at so much naira for every 1000 naira of the sum insured or insurable value. For example, a property to be insured for N500,000. If premium is taken at N10 per 1000 naira, the premium will be 10 divided by 1000, multiplied by N500,000, is equal to N5,000. The factors that may affect rate of premium payable include mode of construction of the building, location of the neighborhood, materials used in construction, nature of occupancy or activities carried out within the premises.
Thank you.